2 in our merchandising operations series, where we'll be discussing or looking at a purchase discounts example and a purchase returns and allowances example. The first one we'll look at is a purchases discounts example. Suppose the Gap store purchased 10 t-shirts on account for $10,000. Credit terms are $210 net $30, and Gap paid within the discount period. The first step is to journalize the purchase of inventory. So this should be more of a review, this first entry here. When we purchase inventory, our inventory is increasing, and inventory is an asset, therefore we debit our inventory for the amount of $10,000 in this case. It also states that we're purchasing these t-shirts on account. So we owe the money, we'll pay it later. And that's a credit to accounts payable for the $10,000. And our description for this entry would be purchase inventory on account. And then of course after our journal entry we would want to post it to our ledger. So here's our inventory T account. We debited inventory, we increased it, therefore we debit inventory in the ledger as well. So now journalize the payment on account. Well, we have to think about this for a second. We owe $10,000, but it said we're paying it within the discount period. So obviously we're taking our discount. And in this case, it's 2% of the amount we owe. We owe $10,000, so 2% of that would be a $200 discount. However, on the books, we have an accounts payable of $10,000, that we owe $10,000 for these t-shirts. But we're only going to pay $9,800 for these t-shirts because we're taking our 2% discount. So what do we debit accounts payable for? Good. We need to take it completely off the books. The books show that we have a $10,000 debt. If we debit accounts payable for only $9,800, then the books would show we still owe $200, and that's not true. So we need to wipe off this debt by debiting accounts payable for the full $10,000. As stated before, we're only going to pay $9,800 in cash because we're taking a $200 discount. But what's the other account that needs to get credited here? Keep in mind there's no such account called purchase discounts or purchase returns and allowances, because remember, we keep our inventory on the books at what we paid for it. So we need to reduce the value of our inventory here. So we're going to credit our inventory for that $200. And our description would be to record payment of inventory on account within the discount period. And again, your description could be much shorter. It could be different depending on the person writing it. Now we need to post our entry. In this case, I'm only going to post inventory as that's the only T account I have. So I'm going to post the $200 to the inventory account to show that I have $9,800 worth of inventory because that is what I paid for that inventory. Now let's look at a purchase returns and allowances example. Suppose We Sell Broken Toys buys $100,000 worth of Lego toys on credit terms of $315 net $45. Some of the goods are damaged in shipment, so We Sell Broken Toys returns $10,000 of the merchandise to Lego. Record the purchase and the return. And in this case, you can omit your descriptions for your entries. So the first thing we want to do is to record the purchase. Let's say that the purchase was on May the 6th. So when we record the purchase, again, we're debiting our inventory for the $100,000, and we're crediting our accounts payable for the $100,000. So let's go ahead and set up our T accounts for both. I debited inventory for the $100,000, so I will post that to the ledger, and I credited accounts payable for $100,000, and I'll post that to the ledger. Now we need to record the return. We're returning $10,000 worth of merchandise. Let's say that we returned that on the 13th. So I no longer owe $10,000 worth of, or in the liability. So I take away $10,000 from the liability accounts payable by debiting it, and I no longer have $10,000 worth of inventory, so I have to take it out of inventory with a credit. And we'll post this journal entry to the ledger. So now I have inventory valued at $90,000, and I also owe $90,000. Now in this scenario, I have two different options for paying. I could pay within the next 15 days from May the 6th and take a 3% discount on what I owe. Or I could pay after the discount period of 15 days and pay within 45 days and pay the total owed of $90,000. So let's take a look at both. So remember, the purchase was made on May the 6th. So how much must We Sell Broken Toys pay Lego if paid on May the 22nd? Well, 15 days is our discount period. And if we purchased them on May the 6th, then the last day of the discount period would be the 21st. So we are not paying within the discount period here. Therefore, we need to pay the entire amount owed. So looking at our T accounts here, we see that we owe $90,000. So we'll need to debit accounts payable for the $90,000. And of course we're paying cash, so we'll credit cash for $90,000. Now let's say that we paid on May the 20th. That is paying within the discount period. And again, our accounts payable shows we owe $90,000, but we're paying within the discount period. So we're going to take the discount of 3%. So there's a couple ways you can calculate either the discount or how much you're actually going to pay. So let's do that first. The first one here is the discount amount. So we take the amount we owe, not the amount of the original purchase, only the amount that you actually owe at this point. Remember, we returned $10,000, so we only owe $90,000 at this point. Times the discount of 3% gives me a $2,700 discount. Or I can calculate the amount of cash I'm going to pay by taking $90,000 times 97%, which is what I'm going to pay because I'm taking a 3% discount. So that means I'm going to pay in cash $87,300. That's what I owe. So I'm going to debit my accounts payable just as before for the entire amount that I owe, which is $90,000, because I got to get that off the books, because I no longer owe Lego money. So I've got to get it off the books. Then I will credit cash for the $87,300. What about the discount? Remember, that's a reduction of your inventory. So we credit our inventory for $2,700. So let's post that to the inventory account to show my new balance in inventory. So my new balance in inventory would be $87,300 because that's what I actually paid for the inventory that's in the account. And obviously my accounts payable at this point, I would post the debit to my T account, and my new balance in accounts payable would be 0.